So imagine a stock that's sitting right at $117.43.
Hmm.
It's backed by, massive institutional deals and this totally jaw-dropping revenue backlog.
Right, but at the exact same time, the technicals are flashing this huge, highly overbought warning.
Exactly. And to make it even crazier, insiders are quietly dumping like $1 billion worth of shares.
Yeah, it's wild. So you have to ask yourself, are you looking at a screaming buy right now, or are you just walking straight into a massive value trap?
That is the ultimate puzzle. You've got these two completely contradictory stories playing out on the exact same ticker, and neither side is willing to blink.
No, they're really not.
Which is exactly why we're tearing it all down today. Welcome to the deep dive.
Yeah.
We are doing a complete ground-up analysis into CoreWeave Inc., ticker symbol CRWV, looking at exactly where things stand as of April 20th, 2026.
And if you want to understand, the actual underlying mechanics of what happens when unstoppable hypergrowth just completely collides with overwhelming debt, well, you're in the right place.
Oh, absolutely. We've got a whole stack of sources here. We're talking earnings reports, charting data, insider trading logs, and all the analyst models.
Right, because our mission today is to look way past those surface-level headlines. We're going to unpack the financial DNA of CoreWeave, decode the technical signals flashing on the charts, and really explore that tension between the institutional bulls and the insider bears.
And real quick, before we jump in, you know the drill. Please like the video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave your comments and feedback down below. We want to hear from you.
Yes, definitely let us know what you think. And just to establish the baseline here, our discussion today is a natural human debate about the data. We're synthesizing the facts, but this is an exercise in critical thinking, not financial advice.
Definitely not financial advice, but man, it is certainly a masterclass in market psychology. So let's just get into it. Before we dissect the underlying value, we need to look at how the market is actually digesting this asset right now.
Okay, let's unpack this.
So as of the close on April 20th, 2026, we're looking at a current market quote of $117.43.
Which came with a really modest daily gain of just 0.5%, right?
Yeah, exactly, 0.5%. And the day range was actually pretty tight, like 110 to 118. But when you zoom out, that 52-week range is where the whole narrative just starts to fracture.
Oh, for sure. I mean, a 52-week low of $33.52, all the way up to a high of $187.
Right. And we are talking about a company with a market cap of over $61 billion, 61.73 billion to be exact.
Which is huge.
It is. And it's trading roughly 28 million shares a day on average over the last 3 months. But it's swinging by literally hundreds of percentages in a single year.
Yeah, and that tells you the market is just fundamentally struggling to price the future cash flows of this company. I mean, an established $61 billion enterprise does not swing from 33 to 187 unless there is some profound structural uncertainty about the business model.
It's crazy.
It really is. The price action here is basically a real-time reflection of investors just violently revising their growth models like week by week.
So let's talk about where we sit within that violent swing today. What are the technical indicators actually revealing about the momentum right now?
Well, if we evaluate the trend direction, we're definitely witnessing some consolidation. There's some short-term weakness, obviously, since the price has retreated significantly from that 187 peak.
Right, it's cooled off a bit.
Exactly. However, the broader momentum originating from those 52-week lows, it remains structurally bullish. The stock is still defending its territory above both of its primary moving averages.
Okay, so give us those numbers. Where are the moving averages?
So the 50-day moving average is holding at $89.11, and the 200-day is positioned at $101.78.
Okay, so it's above both.
Right. So for momentum traders, as long as the price sustains itself above those thresholds, the long-term trend remains completely intact. Key support is sort of coalescing near that $90 to $92 zone.
Which is like the absolute floor the bulls have to defend.
Yes, exactly. And then resistance remains pretty distant, way up at that 52-week high of 187.
Okay, I hear you on the moving average defense, but I really have to push back hard on the idea that the broader trend is healthy right now.
Oh, really? Why is that?
Because there is this glaring red warning light on the dashboard. The RSI, the Relative Strength Index, it's sitting at 92.88.
Oh, wow. Yeah, that's high.
It's absurdly high. For those listening, think of the RSI like a rubber band that represents buying pressure, As the price goes up, the rubber band stretches. A 92.88 RSI means that rubber band is stretched to its absolute physical limit.
There's basically no slack left.
Right. There are practically no new buyers left to pull it any further. It's like redlining your car engine while driving down a steep hill.
Which is the mechanical reality of an overbought condition.
Exactly. And so a snapback becomes practically a physical inevitability. It's not just that the stock might pull back, it's mathematically forced to. Once the buying volume exhausts itself, even a tiny trickle of selling pressure is going to cause the price to just collapse inward. The engine has to cool down.
I see where you're going with that, and the physics of that analogy totally hold up. An RSI over 92 is definitely screaming for a cooling off period. You just rarely encounter an RSI that elevated on a large cap stock.
Right. Unless there's like a short squeeze or something.
Exactly. It usually indicates a severe dislocation in the market mechanics. It means the stock has run way too hot, way too fast, and the current valuation might be suspended purely by speculative momentum, not actual fundamental accumulation.
So with the stock running that hot on the charts, we really have to look under the hood at the underlying engine. We need to evaluate whether the actual financials can even support a $61 billion valuation.
Let's do it.
So let's dig into the fiscal year 2025 income statement. Total revenue reached $5.13 billion.
Which is up a massive 168% year over year.
Yeah, 168%. You see a top-line explosion like that, and honestly, the premium valuation starts to seem somewhat rational, right?
Sure, they're scaling revenue at just an unprecedented clip.
And here's where it gets really interesting. The bottom line tells a completely different story.
Oh, the bottom line is severely negative.
Yeah. They posted a GAAP net loss of $1.17 billion. The earnings per share over the trailing 12 months is a negative $2.75.
Right.
So they're bringing in over $5 billion, but they're bleeding out over $1 billion in the process.
Well, this is where we really have to peel back the layers of GAAP accounting, because taking that net loss at face value kind of misrepresents the actual cash-generating capability of a cloud infrastructure company like this.
How so?
So CoreWeave is executing a tectonic hyper-growth strategy. They are aggressively prioritizing infrastructure scaling over immediate GAAP profitability. If you actually look at their adjusted EBITDA, it was $3.09 billion for 2025.
$3 billion.
Yeah, which represents a 60% margin.
Okay, I want to pause on that because a $4 billion swing between a GAAP net loss and a positive adjusted EBITDA is just staggering.
It's massive. And it basically all comes down to hardware depreciation.
Right. When you're building data centers for artificial intelligence, you're buying tens of thousands of top-tier processors. And under accounting rules, you literally have to write down the depreciating value of those physical assets every single quarter.
Which absolutely crushes your net income on paper. Precisely. Because the hardware has a relatively short functional lifespan before it becomes obsolete, right? So the depreciation schedules are just punishing.
Yeah.
But the thing to remember is that depreciation is a non-cash charge. It doesn't mean money is actively leaving the company's bank account.
That makes sense.
Yeah, so the actual operating cash generated by the core business before those accounting deductions and the interest on their debt is very robust. I mean, sustaining a 60% EBITDA margin while scaling at 168% year over year is a phenomenal operational feat.
I'll give them that. It proves the margin profile of the business works in a vacuum. But, businesses don't exist in a vacuum. They have to actually pay for all that hardware up front.
True.
Which brings us to the balance sheet.
Data.
And the balance sheet is frankly terrifying. Total assets are listed at $49.30 billion. Cash on hand is $3.16 billion.
Okay.
But then you look at the liabilities, $29.82 billion in total debt.
Right.
Yeah. And because of the aggressive investments they're making, their free cash flow for fiscal year 2025 is a negative $7.25 billion.
Right, because the capital expenditures required to build out AI and cloud computing infrastructure are just astronomically high right now.
Let's contextualize those capital expenditures because honestly, the numbers are almost too large to comprehend. In 2025, their CapEx was $14.9 billion.
Incredible.
They're essentially buying a new nuclear aircraft carrier's worth of computer chips and servers every single year.
That's a great way to picture it.
And it gets crazier. They're projecting that to double to $30 to $35 billion in 2026. It's basically like maxing out a dozen credit cards to buy up all the commercial real estate in town, just betting entirely on the assumption that you'll have a total monopoly before the bill actually comes due.
What's fascinating here is that the operational hurdles of deploying $30 billion worth of hardware in a single calendar year are monumental.
I can't even imagine.
Right. You're dealing with global supply chain constraints, power availability issues, construction bottlenecks. They are leveraging their balance sheet to the absolute limit because they believe capturing market share today is worth any price.
Which sets up this really fascinating chain of causality. You have almost $30 billion in debt hanging over your head. The only way a company survives that kind of extreme leverage without just collapsing into bankruptcy is if they have absolute ironclad guarantees the future revenue is secured.
Exactly.
Which explains exactly why CoreWeave is so desperate to lock in these multi-year mega partnerships. They literally need the contracts to justify the debt.
And that brings us right to the core of the bull thesis, the institutional partners and the revenue backlog.
Right. Who's actually buying into this?
Well, the bulls argue that the debt is entirely manageable because the future cash flows are already contracted. Take a look at Jane Street, for example.
Okay, the trading firm.
Yeah. They recently committed to $6 billion in cloud computing deals with CoreWeave. But more importantly, they made a $1 billion direct equity investment.
I really want to analyze the motive behind that Jane Street deal because it is brilliant from both sides. Jane Street is a quantitative trading firm, right? Computational power is their absolute lifeblood.
Oh, 100%.
By taking a $1 billion equity stake in the company that provides their cloud infrastructure, they are essentially hedging their own operating costs.
Yes.
They guarantee themselves priority access to top-tier compute power in a highly constrained market, while simultaneously profiting if the infrastructure provider actually succeeds.
It is a profound vote of confidence from one of the most sophisticated quantitative firms on the planet. And deals exactly like that are what's fueling CoreWeave's backlog.
Give us the backlog numbers.
So at the end of 2025, their contracted revenue backlog reached $66.8 billion.
Unbelievable.
And following the recent expansions with Meta and Jane Street, projections suggest that backlog is swelling to $88 billion.
We really need to define what that means in this context. Contracted backlog means enterprise clients have signed legally binding agreements to purchase compute time over the coming years.
Right. It's guaranteed.
It is $88 billion in future guaranteed revenue for a company currently valued at $61 billion.
So if you're an institutional bull, you look at that $88 billion pipeline and you argue that the current valuation is not just reasonable, it's drastically undervalued. You're basically buying future locked-in cash flows at a massive discount.
I understand the bull narrative, I really do. But here is where the causality flips, and we have to look at the bear case. So what does this all mean when we look at insider activity?
Right.
Think about it. If you hold the keys to an $88 billion guaranteed gold mine, you do not unload $1 billion of your own stock.
No, you definitely don't.
But over the past quarter, company insiders and executives have quietly liquidated over $1 billion in shares.
It is a remarkable volume of insider distribution.
Are they just diversifying their portfolios, or do they see a structural wall approaching that the retail market is just completely ignoring? Because the bears look at that insider selling and point straight back to the balance sheet.
Yeah, the debt-to-equity ratio is really the anchor of the bear thesis here. It's currently sitting at roughly 648%.
648%.
Yeah, that means the company's growth is financed almost entirely by external creditors rather than actual shareholder equity.
Let's break down why a 648% ratio is so dangerous right now. In a high interest rate environment, servicing $30 billion in debt becomes just a relentless drain on your operating cash flow.
Oh, absolutely.
That beautiful 60% EBITDA margin we talked about earlier, a massive chunk of that gets immediately cannibalized by interest expense before it ever even reaches the bottom line.
The execution risk is staggering. I mean, if there is any delay in bringing those new data centers online, or if a major client tries to renegotiate their backlog contract, CoreWeave still has to make those interest payments regardless.
Yep, the bill always comes too.
Right. And because of this razor-thin margin for error, a lot of quantitative models view the stock as severely overvalued right now. Some analysts actually argue the stock is currently trading at a 68% premium to its intrinsic value.
Wow. 68%.
Yeah, calculating a quote-unquote fair value target closer to $70 a share.
Down from 117. And see, this dynamic is the exact anatomy of a retail value trap.
How so?
Well, you're a retail investor, you log into your brokerage, and you see the flashy headlines. 168% revenue growth and $88 billion backlog.
Right, it looks amazing.
Exactly. You see Meta and Jane Street committing billions. The narrative feels totally invincible. But under the surface, the debt is suffocating the equity at 648%. The technical RSI is flashing physical exhaustion at almost 93. And the very insiders who built the company are taking $1 billion off the table. The retail trader buys the headline, but the insider sells the reality.
It really highlights the asymmetry of information here. The institutional players recognize that an $88 billion backlog is only valuable if you can actually afford to build the infrastructure to service it without bankrupting the company in the process.
Exactly. So we basically established the two extremes. The best case recovery scenario. CoreWeave executes flawlessly. The $35 billion in new hardware comes online with zero delays. They fulfill the backlog, and they aggressively pay down the debt, growing into their valuation.
That's the dream scenario.
Right. And the worst case continuation lower. The interest payments cripple their cash flow. That overbought RSI snaps back violently, and the stock plummets to that $70 fair value or even lower. Facing those two realities, where do the professional analysts actually land?
Well, if you aggregate the analyst ratings, the consensus label is currently a moderate buy.
Moderate buy. Okay.
But relying on the consensus label here is incredibly misleading. You really have to examine the spread of the underlying price targets. The lowest analyst target out there is sitting at just $32.
Wait, 32? That is essentially modeling for the worst-case debt spiral.
Exactly. At 32, that analyst is predicting the leverage just crushes them entirely.
Wow.
Conversely, the highest target on Wall Street is $295.
From 32 to 295. That is not a minor disagreement over revenue multiples. Those analysts are modeling two fundamentally different universes.
They really are. Now, the average lands around $127.03, which is slightly above current trading levels. But an average is kind of meaningless when the standard deviation is that extreme.
Yeah, it doesn't tell you much.
Right. It just underscores the undeniable truth that nobody, not even the most sophisticated institutions, truly knows if this unprecedented financial experiment will work.
So let's map out the timeline for how this resolves. In the short term, over the coming weeks, what is the outlook?
Short term, the outlook is heavy, unpredictable volatility. The negative technical signals and the overbought conditions are just going to constantly battle against that institutional buying pressure.
Makes sense.
However, everything is building toward a singular catalyst. The Q1 2026 earnings report, which is scheduled for May 7th, 2026.
May 7th is the crucible. I mean, if they miss on a single metric, if revenue slips, if EBITDA margins compress due to interest, or if they announce even higher CapEx requirements, the market could punish them violently.
Oh, absolutely. The valuation leaves zero room for error. But if we look past the immediate earnings volatility and evaluate the long-term outlook, the internal projections remain aggressively confident. The company is currently guiding for 2026 revenue between $12 billion and $13 billion.
Wow.
Yeah, that would represent another 140% year-over-year expansion.
And what about beyond 2026?
Well, their stated objective is to achieve a $30 billion plus annual run rate by the end of 2027.
30 billion.
Yeah. And if they successfully reach $30 billion in recurring annual revenue, a $61 billion market cap will actually seem incredibly cheap in retrospect.
That perfectly summarizes the incredible tension at the center of this asset. On one side, you have an unstoppable hyper-growth engine with an $88 billion contracted pipeline, deeply embedded partnerships with the biggest players in tech, and a clear path to $30 billion in annual revenue.
Yep.
But on the other side, you have a company battling a staggering debt-to-equity ratio of 648%, navigating $1 billion in insider liquidation, and fighting a chart that is screaming for a brutal correction.
This raises an important question, though. It really forces you to distinguish between a company's fundamental vision and the reality of its stock price.
That's a great point.
The vision of powering the next generation of cloud infrastructure is super compelling, but is a price of $117 justified right now, given the monumental execution risks and that crushing debt load?
Right.
That is the dividing line between Analytical investing and simply buying a popular narrative.
It is the ultimate test of critical thinking. And, it leaves us with one lingering, pretty provocative thought to consider.
What's that?
Well, we know they spent almost $15 billion on hardware in 2025, and they plan to spend $35 billion more in 2026. But the semiconductor industry moves at a relentless pace.
It really does.
So what happens if a competitor releases a new, exponentially cheaper, and vastly superior chip architecture next year? Does CoreWeave's mountain of newly purchased hardware become functionally obsolete before they even finish paying off the $30 billion in loans they used to buy it?
Oh, wow. That is the unseen risk, isn't it? Leveraging yourself to the absolute limit in an industry defined by rapid technological turnover.
It's a risk that could unravel the entire narrative, or, maybe it'll merely be a speed bump on the road to a monopoly. What do you think? Are they building an empire or just a house of cards?
It's going to be fascinating to watch.
Absolutely. We want to hear your analysis, so be sure to like the video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave your comments and feedback below. Let us know. We'll see you next time on The Deep Dive.